Felicity Walsh from Franklin Templeton. Welcome to the Alternative Symposium.
Thank you, Drew.
I've got a couple of important questions for you today. The first is why alternative assets and why now?
Yeah, well, that's a great question. Why alternatives? Really what we're looking at when we're putting alternatives into a traditional portfolio of fixed income equities and cash is trying to give investors something different, so something they can't get out of those traditional asset classes and something that's going to help them meet their goals more quickly or with more certainty. So different types of investors, we could go on about that for days, need to use these alternatives to achieve their goals in different ways.
And for those kind of fixed income and equity heavy portfolios, what are the biggest challenges you see advisors or institutions facing this year?
Yeah, so absolutely. So obviously we've had, a long run of really low rates, and that's really brought some of these alternative asset classes to the fore. So in particular, the obvious one is obviously private debt, yielding a good few percentage points above your traditional fixed income. And even if we see some rate rises coming through and those traditional fixed incomes kind of picking up with yield, you're still going to see more coming from the private debt markets because obviously you're taking on more risk, you're taking on liquidity risk in a lot of cases. So for investors looking for income, so retirees, investors in decumulation phase, we're likely to see that those kind of asset classes are still going to prove very popular.
And what other trends are you seeing in alternative asset kind of flows?
Yeah, so trends. So look, the trends have been phenomenal and, market driven over the last 10 years or so. So obviously the private debt world has sprung up because non-bank lending's really taken off post GFC, still in its infancy here really versus the US and Europe. So absolutely expect that to be, really strong over the next 12 months or so. Private equity, again, companies are listing later than historically, so they're sitting in that pre-IPO stage for a bit longer. That means that, more funding needs to go into that late stage VC, PE space than perhaps 10 years or so ago. One other area that I think is really interesting that I think is going to be quite big this year is the commodity market. So commodities have been relatively quiet, but obviously they're providing a different return driver to what you're getting from your listed equities, fixed income, and all the dynamics with geopolitical tensions and energy and supply chains are obviously driving that volatility in commodity markets. And certainly there feels like that's something that for 2022 is something for us to look out for.
And given your experience on the institutional side, what do you think the advisory market could take from that part of the industry?
Yeah, that's a good question. And look, instos are typically allocating around a quarter of their portfolio to alternatives. What I would say is I think there's a lot of things, the instos have perhaps led the way, and that has led to the advisor market being able to take advantage of some of the good work that they've done. So, they've done a lot of work with managers, re-educating them on fee levels. So gone are the days of 2 and 20 hedge funds. So I think advisors, that space is really going to pick up from the the better fees. I think just education and understanding and trial and testing some of these asset classes, which are newer. The instos have been investing in these alternatives for well over 10 years now, through different cycles. So there's a lot of learning, a lot of data that can be applied that we can say, okay, this does work in this environment or doesn't work, and that's certainly something that advisors can leverage.
And should alternatives be a single bucket?
Should it be a single bucket? I think for the purposes of our discussion, we're talking everything outside of the traditional asset classes. So you've got real estate, right down to liquid hedge funds, liquid alternatives. They're all trying to achieve different things, and they'll mean different things to different client portfolios. So it really comes back down to what are you trying to achieve in your client portfolio? What stage is the client at in their cycle? What type of investor are they? And therefore, how do you then apportion those alternatives appropriately to meet these objectives of that portfolio you're looking after?
Felicity Walsh, thank you.
Thank you very much, Drew.